Welcome back to the Deep Dive. Today, we're tackling something huge, something that really hits home for everyone. Our money, our personal finances.
That's right.
We've dug into a really practical, no-nonsense plan for getting financially fit. We want to show you how to apply some maybe surprising facts to your own situation.
Exactly. And the material we're drawing from, it's not, super complex or academic, not boring theory.
No jargon.
Right. What we found is that some of the biggest, most life-changing ideas about money are actually, pretty straightforward.
Simple but powerful.
Very. It's really about challenging those myths we all kind of absorb, and understanding that winning with money, it's like 80% behavior.
80%.
Yeah. And only maybe 20% knowing the technical stuff, the head knowledge.
That 80-20 thing is, wow, that's huge. We spend so much time on but you're saying the how is the real key.
Absolutely. Think about it. Like someone knows compound interest is amazing, right? Head knowledge.
Yeah.
But they keep leasing new cars or buying on payments instead of actually investing. The knowledge is there.
But the behavior isn't lining up. Instant gratification wins.
Precisely. Or they get budgeting in theory, but can't stick to it.
Yeah.
Spending driven by emotion, maybe keeping up appearances.
Right. The discipline isn't there.
Exactly.
Yeah.
So that's our mission today. Guide you through a practical step-by-step way to get control. Starting with step one, which is kind of the hardest.
Getting honest.
Getting brutally honest about where you actually stand.
Okay, let's get into that. This honest assessment. It feels like the first big hurdle, right? Facing reality. It's like physical health you can kind of see if you're out of shape.
Yeah, it's harder to ignore.
But with money, it's easier to hide, maybe even from yourself. You could look successful for a while.
Oh, definitely. Let's take Sarah and John, real example from the source. Combined income, $75,000 a year.
Sounds okay.
Looked okay. They had what people call normal debt, a small student loan, car loan, maybe $5,000 on a credit card.
Pretty standard stuff for a lot of folks.
Right. They even decided, hey, let's build a bigger house. But underneath all that, virtually no savings. A few $100, maybe?
Wow, okay. Thin ice.
Very thin. Then boom, September hits. Sarah loses her job.
Oh, no.
Just like that, family income drops from $75,000 to $30,000. Overnight.
And with no savings.
Suddenly, they're facing foreclosure, car repossession, the whole nightmare.
Yeah, that's a wake-up call. A painful one. It forced them to look in that financial mirror.
Exactly. And that's the real danger for a lot of us. If life isn't, actively smacking you around right now.
You get complacent.
Yeah, you might be in more danger of just drifting into mediocrity or even crisis later because you're just not willing to make big changes when things feel okay.
It's that frog in the water story, isn't it?
Precisely. Turn the heat up slowly. The frog doesn't notice, gets cooked. The enemy of doing great isn't doing awful. It's doing just fine.
So the big takeaway here first is, you are the problem with your money.
Yeah.
Ouch. But also,
you're also the solution. It starts and ends right there in the mirror, taking responsibility.
okay, so once you have that realization that, okay, I need to change, the next fight is against all those ideas society feeds us.
Yeah.
Right? Especially about debt.
Oh, yeah. The debt myths, they're everywhere.
Let's unpack some of those. Where should we start?
Well, the biggest one, maybe the most dangerous, is that debt is a tool. That you can use it to get ahead, build wealth.
People say that all the time. Leverage. Right.
Right. But the truth is, for most people, debt just adds massive risk. It rarely leads to actual prosperity. The wealthy, they use it way less than we're led to believe.
Interesting.
I learned that the hard way, actually. Went bankrupt myself years ago.
Yeah.
And I was taught debt is a tool in real estate. Big mistake.
Wow. So personal experience there, too.
Oh, yeah. Like the proverb says, the borrower is slave to the lender. Debt, our source argues pretty strongly, just carries too much risk. It wipes out any potential upside from leverage for the average person.
Okay, let's look at some specific examples. Our source calls them dumb math and stupid tax moments. Love that phrasing.
Yeah, it cuts right through. First up, rent to own.
Ah, those places.
You might pay, say, $1,800 total for a washer and dryer.
That you could use for what, a couple $100?
Exactly, maybe $200. It's just predatory lending, plain and simple, targeting people who feel stuck.
And what about 90 days? Same as cash. Sounds tempting.
Very tempting. Great marketing. But the reality, our source says 70, even 80% of those deals, they convert to debt.
And the interest rate is usually terrible.
Awful, like 24 to 38%. And get this, they often backcharge the interest all the way to the purchase date.
Ouch. So that $1,000 stereo isn't making you rich in 90 days.
Not a chance. But $1,000 in savings, even earning a little interest, that's actually building something. Small, but real.
Okay, then the big one for so many people, car payments.
Oh, yeah. One of the absolute dumbest things people do financially. Destroys wealth potential.
What's the average payment now?
It's high. Around $495 a month, usually over 64 months. That's over 5 years.
Okay, $495 a month. Now run the numbers if you invested that instead.
Okay, imagine this. $495 a month invested from age 25 to 65. If you got a 12% average annual return, which, is typical for long-term stock market investing,
Okay.
over $5.88 million.
$1.8 million.
Million, yeah. Is that shiny new car worth almost $6 million over your lifetime?
No, definitely not.
And the funny thing, the average millionaire, they drive a 2-year-old car, paid for, no payments.
That says a lot.
It does. After I went broke, I drove a real junker, seriously, held together with hope, mostly. Now, I buy slightly used, good cars with cash.
And the depreciation on new cars is brutal too, right?
Insane. A new $28,000 car. It'll lose about $17,000 in value in the first 4 years.
$17,000 gone.
Poof. It's like tossing a $100 bill out your window once a week on your commute, just throwing it away.
Okay, so individual purchases are bad. What about debt consolidation? That sounds like a solution.
Sounds like one, but our source calls it a con.
Why a con?
Because it just treats the symptom, the pile of bills. It doesn't fix the root cause, which is usually overspending or not saving enough.
Right, you're just moving the debt around.
Exactly. You can't borrow your way out of debt. The stats are pretty damning. 70 to 80% of people who get consolidation loans, they end up right back in debt in a few years anyway.
Digging the hole deeper, just in a different spot.
Precisely.
Are there other solutions that are actually traps?
Oh, yeah. Cash value life insurance often falls into this category. Things like whole life, universal life.
Or are those bad? People sell them hard.
They do because the commissions are high, especially in the first few years. But the returns for you are usually really low, maybe 2.6 to 7.4%, sometimes less.
That's not great.
And worse, the cash value you build up, that savings part. Your family usually doesn't get that, plus the death benefit when you die. They just get the face value of the policy.
So you're paying for savings you might not even get back.
Pretty much. You're almost always better off buying cheap term life insurance, just pure protection, and investing the difference yourself.
Okay. What else? Credit repair companies.
Be super careful there. Many are scams. Some might even tell you to do illegal things, like trying to get a new social security number to wipe your credit.
Whoa, that's serious.
That's fraud. Big trouble.
And a tough one, but important. Divorce. Our source had a specific warning.
Yes. Painful but crucial. If you're getting divorced, you have to make sure any joint debts are refinanced solely into the other person's name, or force the sale of the asset.
Why so critical?
Because if your name is still on that loan and your ex messes up payments years down the road, it can absolutely destroy your credit, even if the divorce decree says they're responsible.
The lender doesn't care about the decree.
They care about whose name is on the contract. You need a clean financial break, period.
Okay, so we've seen the problems, the myths, the traps. How do you actually break free? Our source lays out this system, right? The baby steps.
Yes. And it's brilliant because it's sequential. It builds momentum. You tackle things in a specific order that makes sense psychologically. Small wins lead to big changes.
It's a roadmap.
A proven roadmap. Baby step 1, save $1,000 cash. Fast. As a starter emergency fund.
Just $1,000 to start.
Just 1,000, because it is going to rain financially. It's not if, it's when. Money Magazine found like 78% of us will have a major negative money event in any given 10-year stretch.
Just 78%. That's almost everyone.
Pretty much. So this $1,000, it's your umbrella for the little storms first. Car breaks down, appliance dies. It keeps those small things from becoming debt emergencies while you work on the bigger steps.
And, crucially, Christmas is not an emergency.
No, it happens every December. Plan for it.
You also stress this fund has to be liquid. What does that mean practically?
It means cash. Easily accessible cash. Not tied up in investments where you might have to pay a penalty or wait to get it.
So not in stocks or mutual funds.
Definitely not for this starter fund. If you have more than $1,000 sitting in non-retirement investments, the advice is cash it out. Even if there's a small penalty, get that $1,000 liquid.
Why is that non-negotiable?
Because the whole point is to stop borrowing. If a $500 car repair pops up, you use this cash. You don't reach for a credit card. It breaks the cycle.
Got it. So you get that $1,000 buffer, Then comes this mindset shift you mentioned. Gazelle
Yeah,
intense.
gazelle intense. It comes from Proverbs, the idea of escaping a trap like a gazelle fleeing a hunter, utterly focused, running for your life.
So applying that to debt.
It means you stop all borrowing. Cold turkey. You declare, I am done with debt, never again.
That sounds intense.
It is. And the moment you make that decision, life will test you. Guaranteed, the transmission will blow, your kid will need braces, something will happen.
Murphy's Law.
Totally. And that's the moment of truth. Do you stick to it? And this is why you cut out the credit cards. Like, right now, destroy them.
Get rid of the temptation.
You cannot get out of a hole if you keep the shovel in your hand. Sometimes you got to get really radical. Sell stuff, get a second job, dynamite the log jam, as the source puts it, free up cash to throw at the debt.
And for couples, this has to be a team effort, right?
Oh, absolutely critical.
Uh-huh.
Spouses have to be on the same page, doing a written, zero-based budget together every single month. Not optional if you want to win.
Okay, so $1,000 saved, gazelle intensity on, no more borrowing, working together. What's next after you're attacking the debt?
Once all debt is gone, except the house, we'll get to that. You move to baby step 3, finish your emergency fund, kick Murphy out for good.
So building on that first $1,000,
Yeah.
how much are we talking now?
3 to 6 months of essential living expenses in cash, liquid, safe.
3 to 6 months. How do you decide?
Lean towards 6 months if your income is unstable, like straight commission, self-employed, or if you're single income or have ongoing health issues. More stability. Maybe 3 months is okay.
And you mentioned men and women might approach this differently.
Yeah, the source notes men often see it as just a task, check the box. Women often feel the security aspect more deeply. Usually the spouse who wants the bigger fund wins, and that's probably wise. More security is rarely a bad thing here.
And this bigger fund isn't just about paying bills, is it? It changes how you feel.
Totally. It's like Murphy repellent. Problems still happen, but they don't feel like crises anymore.
Can you give an example?
Yeah, for my own life again. When my wife and I were broke, a $580 heating repair felt like the end of the world. Huge stress recently. We needed a new water heater, $570, with a full emergency fund. Honestly, it was just an inconvenience. I barely blinked.
That's a massive difference in quality of life.
Huge. It turns potential catastrophes into mere annoyances. And if you see real storms coming, a baby on the way, lay off rumors at work. It's smart to pause debt repayment and pile up cash in this fund even faster.
And one more point here, delay the house down payment savings.
Yes. Don't even think about saving for a down payment until you're debt-free, except a current mortgage. And have this full 3-6-month emergency fund firmly in place. Owning a home should be a blessing, not a curse that makes you house poor.
Solid foundation first. Okay, foundation built, emergency fund full, no consumer debt. Now what? Time to build wealth.
Now it's time. Baby step 4, maximize retirement investing.
And another myth pops up here, right? The I'll be fine when I retire myth.
Oh yeah, good one. The cavalry's not coming. Social Security, let's be honest. Surveys show younger folks are more likely to believe in UFOs than expect a full Social Security payout.
Ouch. So it's on us.
Completely on you. Your retirement is your responsibility.
So what's the game plan? How much should we invest?
The target is 15% of your gross household income every year. 15%.
15. Okay, where does that go first?
Always start with your company match in your 401k or equivalent. If they match, say, 3%, you put in 3%. That's free money. Don't leave it on the table.
Free money is good after the match.
Then, fully fund Roth IRAs if you're eligible. Roths are amazing because the money grows completely tax-free.
Tax-free gross and tax-free withdrawals in retirement.
Exactly. Powerful stuff. Quick example. Invest $3,000 a year in a Roth IRA from age 35 to 65. Average 12% return, again, typical long-term stock market stuff.
Okay.
At age 65, you could have $873,000, tax-free. And you only put in $90,000 of your own money over those 30 years.
Wow. The power of compounding and tax-free growth.
It's incredible. And the goal for retirement. Aim to live off about 8% of your nest egg each year. That lets the principal hopefully still grow by around 4%, keeping ahead of inflation.
So if you want $40,000 a year to live on,
you need a nest egg of about $500,000. Work backwards from your goal income.
okay, retirement's getting funded at 15%. What's next on the list for many families? Kids' college.
Right. Baby step 5, college funding.
Now, college is important, but you caution against seeing it as a magic bullet.
Definitely. Knowledge is great, experience is great, but a degree isn't some, genie in a bottle guaranteeing success.
What's the breakdown?
Research suggests maybe 15% of career success comes from the formal training, the education. The other 85%, that's attitude, perseverance, showing up, working hard, having vision, grit.
85%, that's huge. And student loans.
Student loans are a cancer, according to our source. Avoid them like the plague.
Strong words. But the debt numbers are crazy.
They are. About 70% of students borrow. Average debt now is over $37,000 per borrower, and often that debt isn't even paying for tuition.
What's it paying for?
Lifestyle. Living off campus, which can cost $5,000 more per year than a dorm. Spring break trips. Keeping up appearances while getting the degree.
So what are the smart ways to do college without crippling debt?
Encourage your kids to work. Part-time job through college. They'll value the education more, maybe party a little less.
Skin in the game?
Exactly. Consider community college for the first 2 years. Huge savings. Then transfer.
Smart. Other options?
Work-study programs. Like, UPS has a great program paying tuition for part-time night work. Military service or National Guard offer fantastic education benefits.
And scholarships. Don't you have to be a genius or star athlete?
Absolutely not. There are hundreds of millions in scholarship dollars that go unclaimed every year. Not just academics or sports, community clubs, based on heritage, based on field of study, based on where you live, all sorts of criteria. You just have to look.
Digging required.
Yep. Also, look into programs for underserved areas. They might pay for school or pay off loans if you agree to work in a high-need field or location for a few years. Nursing, teaching, some medical, some legal.
Okay, lots of alternatives to loans. What about saving for college? Best accounts.
If your kid is young, say under 8, and your income fits the limits, education savings accounts, ESAs, are fantastic.
Why ESAs?
Flexibility in investment choices. You can put them in good growth stock mutual funds. Aim for that 12% average long-term return.
And the growth is tax-free for education.
Tax-free. If you put $2,000 a year into an ESA from birth to age 18 at 12%, that could grow to $126,000. Tax-free for college.
Wow. Compare that to prepaid tuition plans.
Those typically only keep pace with tuition inflation, which averages around 8%. Same $2,000 a year in prepaid might only get you $72,000. Big difference.
So ESAs are generally better if you qualify. If not,
Then 529 plans are the next best thing. Also offer tax advantages, good investment options, higher contribution limits.
okay. Retirement funded, college funded, we're getting there. What's the big summit?
The summit is baby step 6. Pay off your home mortgage early.
The final debt.
Yeah.
The big one. This is the financial marathon.
It really is. And guess what? More myths here.
Like keeping the mortgage for the tax deduction.
Exactly. People think it's smart, but the math doesn't work. If you pay, say, $10,000 in mortgage interest to save $3,000 in taxes, you're still out $7,000.
Right. You spent $10K to save $3K. Doesn't make sense.
Doesn't make sense. Or the idea of borrowing against your house equity to invest, hoping to make a spread.
Leverage again.
Yeah. But the risk involved, plus taxes on any investment gains. Our source says you really don't make anything when the smoke clears. It's just not worth the risk.
So peace of mind and security trumps potential gains.
Having a paid-for house provides a level of security that having borrowed money invested just can't match. Equity is security.
Okay, so pay it off. Any rules for the mortgage itself if you do have one?
Absolutely. Never, ever take out more than a 15-year fixed-rate mortgage.
15 years max, fixed rate. Why?
Saves you a fortune in interest compared to a 30-year loan. Example, a $110,000 mortgage at 7%. Over 30 years, you pay back $263,520 total.
Okay.
Same loan over 15 years. You pay back $177,840.
That's over $85,000 less interest.
85 grand just by choosing the shorter term, and the payment shouldn't be more than 25% of your take-home pay. Keep it manageable.
25% take home, got it. But paying cash for a house, you mentioned that earlier, it still sounds almost impossible to most people.
Sounds impossible, I know. But people do it. It takes extraordinary desire, though. I call it the 100% down plan.
Like the Luke example.
Exactly, Luke and his wife. Making $80,000 combined. They decided to live on almost nothing. Gazelle intense, right?
Super intense.
Saved $50,000 a year for 3 years straight.
50 grand a year on an $80K income? Wow.
Hardcore. And by age 26, they paid cash for a $150,000 house.
Incredible. What did their friends think?
Thought they were nuts. Totally crazy. Until they bought that beautiful home, completely debt-free. The sacrifice. Absolutely worth changing your entire financial future. Ask anyone who's done it.
Amazing story. Okay, house paid off. What's left? We're at the
But
top.
you just almost. This is baby step 7. Build wealth like crazy and reach the pinnacle point.
Build wealth like crazy.
Oh,
What do
yeah.
you mean?
Means you keep investing that 15% for retirement, maybe more now. You kept saving. You're completely debt-free. You have margin. The danger here, getting comfortable, settling for good enough.
Don't coast too soon.
Right. The pinnacle point is that amazing place where your money starts making more money than you earn from your job.
Your investments are out-earning your salary.
Exactly. You are truly financially secure. Work becomes optional. Life feels like you're coasting downhill, financially speaking. Small bumps don't even register.
That sounds like freedom.
Yeah.
Real freedom. What's the ultimate point of all this, though? Just having a big pile of money.
No, not at all. According to the source, and frankly, based on a lot of wisdom traditions, the most mature, the most fun you can have with money,
Is
giving it away.
giving.
Giving.
Oh,
Generosity. It's possibly the most fun you will ever have with money. Investing is good, enjoying life is good, but giving, that brings a different kind of fulfillment.
like the Secret Santa story.
Yeah, Larry Stewart gave away over $1.3 million, often anonymously in $100 bills, just because it brought him immense joy. He found the deepest purpose in giving.
So the 3 uses for money.
Ultimately, fun, investing, and giving. You haven't really achieved a total money makeover until you're actively doing all 3.
And this whole journey, it's not just about dollars and cents, is it? It changes more than your bank account.
Oh, absolutely. It's a total process. It impacts everything. Your wealth, sure, but also your emotions, your stress levels, your relationships, even your spiritual life.
How so?
Wealth tends to magnify who you already are. If you're generous, you'll likely become more generous. If you're kind of a jerk,
You become king of the jerks.
pretty much. Money gives you more power to be you. Remember, it's the love of money, not money itself, that causes problems. Wealth brings responsibility.
Wow. Okay, so to wrap this up, we've gone from denial and myths
Yeah, facing the truth, busting those debt lives,
to getting gazelle intense with the baby steps,
saving that first $1,000, attacking debt, building the full emergency fund,
then building real wealth for retirement and college,
investing that 15%, avoiding student loans.
paying off the house, and finally reaching that pinnacle point where giving becomes a major joy.
Exactly. It's a journey.
A journey driven, as you said at the start, mostly by behavior.
80% behavior, discipline, sacrifice. But the payoff? Living, as the source says, like no one else later because you were willing to live like no one else now. Having your money work harder for you than you work for it.
We talked about Sarah and John, how crisis forced them to change. But for listeners, maybe not in crisis, let's end with a challenge, a provocative thought.
Okay.
What's the one money thing in your life?
Mm-hmm.
Maybe it's a car, a brand, a spending habit, something that makes you kind of puff up inside when other people notice it. Your status thing.
Your financial Achilles' heel.
Yeah. Are you truly willing to give that up? To sacrifice that thing you secretly love showing off in order to break free from maybe financial mediocrity or even stupidity and achieve real, lasting financial fitness?
That's a tough question.
It is. But thinking about it, that might be the key to starting, the price to win. Our source makes it clear. It's absolutely worth it.